Where does that leave these three cuts in the dot plot from the Federal Reserve? I mean, do you think they will actually cut into this?
It's a good question. I think when we started the year, the first thing I woke up January 1st and I wrote a tweet that was basically like, look, if growth is at or above potential and inflation is still a little too high and unemployment rates at secular lows, like why would you do anything, right? And I think that the spirit of, and that was a time when people thought that they were going to cut like in March
Mm.
for the first cut, and we've moved past that. The idea that the economic expansion is sort of good enough to not create urgency to cut. Plus, I think some of those inflationary pressures are maybe not long-term emerging, but certainly cyclically, we're likely, in a short-term basis in the U.S. context, starting to see some upward pressure on inflation. We've got a couple months of like not good data, not bad data, but not adding confidence the way Chairman Powell is looking for. And now we've got, gas prices are moving up a buck from having fallen a buck, and that has an effect that'll flow through to other prices. And so inflation is likely to be just a bit above what they were projecting out or expecting. And so you put that together, and I think we could easily see a circumstance where, at least, for the next 3 or 6 months, there's not enough confidence to shift towards the cut cycle, given the overall economic environment. And so that's why I think if you get to the end of the year, we may well have a situation where the short rate cuts expected don't come. The long rate is moving up for a variety of reasons, but growth is starting to slow because the effects of those dynamics, right? The rise in rates is starting to affect the economy and asset prices, particularly relative to the elevated expectations.